And welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread, and today we're going to continue talking about investments for the business owner. That's right, we've been dealing with a deep dive, and we've covered cash flow thus far, we've covered risk management, and now we're finally at, as some would say, the sexy part of financial planning. In our last episode, we introduced investments, and we dove straight into IRAs and Roth IRAs, and we dealt with those extensively. Today, we're going to approach a different type of IRA. Well, Justin, I thought investments were about stocks and bonds and real estate and those things. They are, but it's important to understand where to purchase the investments. I was talking with a young business owner probably earlier this year. It's 2019 as I'm recording this particular episode. And earlier this year, I heard a business owner who was buying and trading things in a traditional non-qualified account. Basically, he was buying stocks and options and different things, and he was killing it according to his numbers. But he didn't factor in the taxation. And he didn't factor in tax deductibility. He didn't factor in long-term planning. He was just worried about making money. And whenever we got to talking about it, I said, brother, you realize if you had done it in this manner, then you would not have to pay this much in taxes. He didn't realize that. So whenever we deal with investments, we always want to talk about the placement of investments. So that's why we begin with IRAs, or what we call traditional IRAs, versus Roth IRAs. Today we're adding another IRA. You're like, Justin, I didn't know there was any more IRAs. Actually, yeah, there's a couple more. So today we're going to deal with what is a simple IRA and when should you use it as a business owner. Well, the term simple actually means, and I'm going to quote from the Internal Revenue Service, it means savings, incentive, match plan for employees. So savings, incentive, match plan for employees is the acronym for SIMPLE. And the IRA obviously stands for an individual retirement account. Well, Justin, if we have an IRA already, why wouldn't I just use an IRA? Why do I need a simple IRA? Many times as we grow our businesses, we start off in the early days broke. I'm sure you can remember back whenever you began this empire that you're now dealing with, and you were flat broke. I mean, ramen noodles, like college campus styles, making grilled cheese on the irons. I don't know if you ever did that. It's kind of cool to watch. But making grilled cheese on irons, just living life without a care, trying to get the business off the ground, just flat broke. Before too long, though, you start saving and pulling a little bit of money off, which, by the way, consequently, on a sidebar, little soapbox action here for you. One of the mistakes that many business owners do is they pour all their money back into their business. And ultimately, they end up like an individual I talked to this week who's 66 years old, has a successful business, but has no assets outside the business. So what I'm going to teach you is that we need to pay ourselves first. There's one of my favorite books out there called The Richest Man in Babylon. It's one of my books that I read every year. And the whole theory behind it is pay yourself first. So we begin paying ourselves first. And we begin maxing out our IRA, our Roth IRA, depending on what you need, probably a Roth. But all of a sudden, that contribution limit of $6,000 that I can put in as an individual under 40, and that as Emily can put in as an individual under 40, just isn't enough. Or maybe we got hit with our first tax bill, and it's like, holy Batman, the IRS is just mean. Yeah, no, you just got to play the game. So now all of a sudden, an advisor comes along and said, hey, have you considered a simple plan? What's that? So today we want to cover the simple plan for you. Now look, it is a company-sponsored plan. You may recognize the term 401k. That's also a company-sponsored plan. Today we're dealing with a simple. The cool thing about a simple is that you and I can contribute this year $13,000 into the simple plan if we're under the age of 50. So we can do more than twice as much money. You remember on the IRA, we can only do $6,000. In a simple, we can do $13,000. And if you're over the age of 50, you can do $16,000. So you can get $3,000 more into the simple plan if you're over the age of 50. Now, to establish a plan, the employer must establish a plan on the behalf or to benefit the employees. That's right. You can't just set up a simple plan just for you and your spouse. You have to set it up for the entire organization. You can set the plan up to be effective between January 1st and October 1st. Now, you've got to make sure there wasn't any other plans in place, etc. And if you had a previous simple plan in place, there's a little different rules there. Today, I'm not trying to dive into all the rules, guys. Let me tell you, there's chapters in the Internal Revenue Code on these plans. I just want to hit the high levels for you. Now, the cool thing about the simple plan is that once it's established, the employer is required to contribute at least to the plan each year until it's terminated. That's one of the things I like about it. It creates discipline. The IRA, if you have a bad year, you're going to kind of figure out a way how to weasel out of paying yourself first. In a simple plan, you are required to contribute to it each year until it's terminated. And a little bit of requirement, you say, Justin, that's not a cool thing. I don't like that. I don't like inflexibility. The reason why I think it's cool is because it forces human behavior. It forces us to do what's best for our long term, not just what's in the immediate need that we have to deal with. Now, here's one of the things that many times I can argue is like, ugh. What I'm dealing with here is if you set up a simple plan, the Internal Revenue Code is going to require that you contribute between 2% to 3% on behalf of your employees. The rule actually reads, I'm going to read directly the rule, it says, employers may change your contribution decision between 2% mandatory contribution and the 3% matching contribution. And there's a whole section here on the requirements. So you can make a mandatory at least 2% contribution for all your employees. Or you can make an optional matching contribution. Let's tear that down. What does that mean? Let's say you have 10 employees. If you go with a 2%, then let's say that you have employees making, just for simplicity, you have employees that you're paying $100,000 a year to each of them. You've got to give them, free and clear, 2% at least. That's right. They don't even have to participate. They don't have to defer any of their own money into the plan. You just have to give them 2%. Now, some businesses, that's very, very reasonable. Some fields, it's expected even. Some people, though, some businesses in some fields, it's not expected. So the service allows us to actually make a 3% matching contribution. That means if you're dealing with a lot of younger individuals who aren't really worried about their future, as many of us have been in our past, to our own demise ultimately, but maybe they're not saving as much or not saving as all, you can put a 3% matching contribution. So for those individuals who don't who don't contribute to the simple plan, you don't have to give them any money. Typically, whenever I set these up for clients, we have to take a case-by-case scenario. Sometimes we do the 2% mandatory matching. Sometimes we do the 3% optional. The 2% mandatory contribution, not matching. Or sometimes we do the 3% mandatory contribution. Now, to participate, here's where it gets kind of tricky. To participate in this plan, the employees in your organization must have earned at least $5,000 in compensation in any 2 previous calendar years. So you just hire somebody right off the bat, they're not going to be able to participate in the plan right away. They have to have earned at least $5,000 in compensation in any 2 previous calendar years. I ran into a case one time where this individual had hired somebody. They worked for him for a while, made some decent money. They fired him. They hired him back. And the individual did not want to place them onto the simple plan. But this rule provided that new hire back, even though they were just a new hire again, this rule required them to actually participate and the employer to make the contribution. They were doing a 2% mandatory contribution, and the employer had to make the contribution because that employee, even though they just hired him back, they had worked and earned more than $5,000 in the last 2 calendar years. Now, look, you can use a lot less restrictive. You can make it to where everybody the day they're hired is eligible for the simple plan. That can be done. The service typically tells us the maximum penalty or the maximum amount of restrictions that we can put onto a plan. The idea being, simply, guys, and I'm going to overly state this, the idea being that us business owners shouldn't be looking out just for ourselves. And you've heard me talk about the team. In fact, some of the most stressful decisions I have to make is about team and moving people around, management, etc. I know that you care for your team members. I know you care for your employees. I hear your hearts in our meetings. I hear your hearts whenever I get on the phone with you. Man, I heard some heartbreaking things this week of some successful business owners, very successful business owners called our office and actually reached out through the Financially Simple website and said, hey, man, I need some help. If that's you and you say, hey, brother, I need some help, reach out. Go to financiallysimple.com. I think in the top right-hand corner it says work with Justin or work with my team or something like that. Reach out, and we've got an unbelievable amount of experts here who can help. And someone did that, and we were talking. We're ultimately going to be able to help them, but man, just the heart that this individual had for his team was just full of compassion. It warmed my heart. It did. So I'm not trying to get all warm and fuzzy here. I'm rough and tough. Anyways, on the simple plan, one thing that you have to keep in mind is if you have more than 100 employees, you can't use it. You can't use it. You're like, dude, no worries. Yeah, well, a couple of clients we have more than 100 employees, so they can't use a simple plan. They have to use a different type of a retirement plan for their benefits. And the only other really big key is you can't place it on a fiscal year basis. Now, I know a lot of our business owners are cash basis versus accrual-based accounting. So a simple plan you actually have to use on a calendar year basis. That's just one of those unusual, caveats you have to know about. Now, one of the pros of the Simple IRA, the pros is they are super easy to establish. Let me tell you, folks, these things are so stinking easy to set up. They have only a little bit of paperwork. Basically, you fill out one form. It's actually called Form 5304 Simple. We're going to put a couple of links to these on the website. At your institution of your choice. So we use in our registered investment advisor, Heritage Investors, we use TD Ameritrade as our custodian. We set up a simple here this month actually for somebody. We set a simple plan in place, open the account for each of the participants in that plan, set the rules in place at TD Ameritrade. I'm telling you, it was really, really, really easy. The only thing that you as the employer have to do is you have to fill out a Simple IRA adoption agreement, which is going to kind of outline what are the eligibility for the participation in the plan. It's relatively easy. It really is. We have a link to one of those in our blog post on the Financially Simple website. Now, one of the interesting things in the plan is you may be eligible for a tax credit. Now, it just depends on your particular circumstances, but the Simple IRAs can receive a tax credit for 50% of necessary eligible startup costs, up to a maximum of $500 per year. And you could do that for the first 3 years of the plan. So if there is some administrative cost, let's say you go and you hire a custodian that's going to charge you a adoption agreement paperwork fee or whatever the number is, you can actually get a little bit of a tax credit. So about $250 in tax credit, which will help you offset the cost. Not many CPAs know about that, by the way. So it's one of those things you want to keep in the back of your head. Not always the case, but many times it can. Now, in a Simple IRA, contributions can be invested into a number of different things. You can buy individual stocks, mutual funds, or other similar type of investments. Most of the plans are going to have ETF, exchange-traded funds, mutual funds, and target date funds. Target date funds being funds that have a particular date in the future, that as you approach that date, the investment becomes more and more conservative, thus trying to preserve or reduce the volatility of that investment. We're going to just use a lot of technical terms we're going to talk about in the near future. But in the Simple IRA, you can invest it in a lot of different things. When it gets interesting on a Simple IRA, because you can contribute your $13,000 to your Simple IRA, and you can contribute to your Roth IRA, your $6,000. So you technically could set back $19,000 a year into a simple and an IRA or a Roth IRA. You can do that. But if your adjusted gross income, actually it's called a MAGI, your modified adjusted gross income is greater than $189,000 for a married filing jointly, then you're going to start running into some exclusions that you may not be able to make full contribution amounts. Justin, you just lost me. Okay, here's the deal, folks. Many times as business owners, we go through the year expecting what our profits are going to be. We think, okay, we're paying our paychecks if we're an S corporation or a W-2 employee of our own company. We're paying our paychecks, or we're taking our distributions or guarantee payments, whatever the structure is, and we're estimating how much money we can put back. And so let's say that we put back $1,100 a month for the whole year. We maxed out or got real close to maxing out our simple. And the company gave us our 2 or 3% mandatory match or participating match. But at the end of the day, we have a little bit more money that we didn't spend. Some of my best clients are extremely frugal. They don't spend everything they make. And they want to preserve some money into maybe a Roth IRA. You can actually do that. You can place money into a Roth IRA, into a simple IRA. You can. Now, there's some rules, and there's some limitations and some exclusions. There's some thresholds and some phase outs, all these different type of rules. Basically means if you make too much money, you can't do it. But one of the pros is with a simple is you can make a contribution to an IRA or a Roth. Now, there's lots of cons, a lot of negatives to the simple. One of the things that's, to me, the biggest negative to a simple IRA is a business owner can't save as much as you could potentially into a SEP, a simplified employee pension, which, by the way, we're going to talk in detail about our next episode, or a 401k. You just can't put as much money into it. Me, I'm age 40 years old. If I want to save $20,000, I can't do that in a simple. I can in a 401k or a SEP potentially. So that's one of the drawbacks. If you're pretty successful in your business and you're just trying to supercharge your family's retirement, a simple may not be a good one. Another negative for the simple is you can't roll it over. You can't move it from the simple IRA to the traditional IRA without a 2-year waiting period. And so the rule is, what I've seen this happen a couple of times in my career, almost 20 years, where someone will start a simple IRA and it didn't work out, so they shut it down. Now they got $4, $5, $6, $7, $10, $15,000 in the simple, and they want to move it to the IRA. They can't. You actually have a 2-year waiting period from the time the employee first joined the plan before you can move it to a IRA. 401k is not like that. Neither is a SEP. Okay. Now, SEP IRAs and traditional IRAs cannot be rolled into a simple. You have to keep them separate. So if you have a simple IRA and you're like, I have this old 401k over here at my previous job, or I had this old IRA over here and I'm trying to figure out how to do some Roth contributions, but I don't want to do a backdoor Roth, and there's all sorts of strategies there. You can't combine accounts. You got to keep them separate. You can't move a SEP or an IRA into a simple. Can't do it. So even though they have SEP IRAs, simple IRAs, and IRAs, you can't combine the two together. Another negative for me is that the simple IRA does not allow for a ROTH option. Doesn't allow for a ROTH option. So if you go with the simple plan, the only ROTH option you're going to have is a individual Roth IRA. And it may or may not be able to work. It depends on the incomes and all those different things. So that's one of the negatives for me on a simple. So let's boil it down to this. Who in the world should use a simple IRA? I'm going to say it's traditionally is if you're just getting started on paying yourself first, you've been maxing out your Roth or your traditional IRA, now you want to save a little bit more, you may consider simple. Give you another scenario. Let's say you've got a good talent pool and you're trying to recruit additional talent, but you keep hearing that, man, you don't offer a retirement plan. You really don't want to go in the 401k world because of the scares and the fears that you have there. A simple plan allows you to offer a retirement plan and still give a contribution of 2 or 3%, depending on which selection you go with. So a simple plan is simple, hence the reason why we call it a simple IRA. It works many, many times in lieu of 401ks. It works many, many times in lieu of very expensive plans. So a simple IRA, maybe you never heard of one before. You're like, Justin, this is Russian to me. Hey, reach out to us. You can hit me on Twitter, LinkedIn, Instagram, Facebook. I mean, we're just about everywhere, guys. YouTube. This is actually now being aired on YouTube. Look, I'll tell you this. Life is hard. Retirement plans can drive you batty trying to figure out all the different pros and cons and how to couple them. But money doesn't have to be frustrating. Look, guys, we're going to continue to make our lives at least financially simple. Y'all go out and make it a great day.